Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us on our Friday Insights. It's November 19th of 2021. And let's get right to our topic of the day. Thanks for watching. Let's discuss inflation. Now it's on everyone's mind. We are actually feeling it. We're getting ready for Thanksgiving. We're going to feel it at the grocery store, at the gas pump, everything that we're doing. We are in a super crunch. Now the Federal Reserve, who tries to maintain on its dual mandate, price stability is their second mandate. The first mandate for the Federal Reserve is to achieve maximum sustainable employment across the spectrum with regards to just employment in the United States here, but then also allowing price stability to take place. Now, if you look at the CPI report from October, we're plus 6% in just an increase in just the inflation reading. And the Federal Reserve says it has a stated inflation target of 2%. Now, the Fed says, listen, everything that we're seeing right now, for the most part, on majority, now they've softened their language a little bit. And I spoke about this in Bloomberg last week when I was on Bloomberg TV. If you want that clip, we've got it down below in the comments below, so you can click to my interview with Bloomberg TV. But essentially the take-home point is inflation is going to run hot. And the Federal Reserve has now changed their language a little bit, saying, wait a minute, it's not so transitory, which is a term that they use for temporary. They believe that even though we had a hot CPI number above 6%, for the short term, it's going to be short-lived because of supply chain constraints, because we're reopening, and we're basically just getting our running legs back from being down for about 18 months to 20 months post-COVID. Now we're still in the middle of COVID, and that's still a very big thing. Around the world, we're seeing headlines and basically the virus itself change on a day-to-day basis and real time around the world. So that's still with us. We're still living through that, and that's what the Federal Reserve has to navigate through. So do we allow sort of these pricing pressures work their way into the economy and then ultimately sort of diminish over time? That's their belief. That's where they might be more accommodative on interest rate policy, as well as keeping interest rates lower for longer. Now, here's something where we believe at Blanke Schein Wealth Management, if you followed me for a very long time here now, we thank you for doing that. But we believe that, everything on your kitchen table and my kitchen table specifically, inflation is here to stay. So what's our hedge? We keep invested, but here's the anchoring effect of what we believe is actually happening in every aspect of the economy. It doesn't matter what you spend your money on. This is exactly an example that I'm going to give you of the anchoring effect of inflation. So right now we're going through the transitory period of like everything is going to cost more, and according to the Fed, it's temporary. But if you're a business owner, it's not temporary, right? If you're a consumer, you're not feeling like it's temporary, and you're actually worried that it's going to be permanent. But here's what's going to happen as an example that we're predicting for our clients here. Let's say you go out there and buy a new car, and the new car before the pandemic was $50,000. Because of supply chain constraints, because of chip shortages, because of all the XYZ factors, doesn't really matter. Even if you're a business owner, you literally could come up with an excuse to, hey, my competitor's raising prices, I'm going to raise prices too, because the demand is there. So you go from $50,000 for that same car to $60,000. Okay, so the demand is there, supply is short, and that's the world of economics. But when we actually normalize, let's say when the Federal Reserve, fast forward 24 months, 36 months ahead, and we start seeing prices come down, because prices will come down. I mean, one of the theories in economic theory is the cure for higher prices are higher prices. There's going to be some point where you're just, and we're not as consumers going to say, we're not going to pay this. And we're going to, it's okay to wait. And we don't need, let's say, a new car right now, or we don't need that new home, if you will. We're just going to wait and see sort of the market to equilibrize, and easy for me to say. And then, but more importantly, just take its time to work its way through. Well, what happens is that $60,000 vehicle, when supply and demand sort of meet and start equalizing, it doesn't go back to $50,000 what it was before the pandemic, right? The car for the cost of the new car. It really then goes down to, it comes up to a newer price, which now looks like a discount, right? Down from $60,000 to $55,000. But let's start over. Let's go back to the very beginning. We started with that same car make model at $50,000. And then ultimately, let's call it down the road, because of higher input costs, because of everything else that's related, it's a higher vehicle, that's 10% higher just on that new car. So you're going to say, hey, wait a minute, I'm going to see the 50,000 go to 60,000 the new car. That's too much for me. I'm going to be patient. I'm going to wait. New inventory comes online. That same car now goes down to 55,000, not back to 50,000. And that's a 10% increase from where we started. And that's where the anchoring effect happens. So what's our hedge, Rob? What's our take-home point? Like I said in the Bloomberg interview, you have to have your assets across all asset classes diversified, balanced, but invested, because cash right now is that quicksand that can never keep pace. Because what are the banks paying you right now? Yeah, that's what I thought. It's less than 1%, if that. It's probably 0.5% for an entire year. And we've seen all asset classes achieve and reach double-digit rates of return. Now, we're not predicting that for the future. Again, we don't know, but at the same time, we can make a pretty good educated guess and a balanced approach and put that money work for you. If you have extra money outside of Blanke Schein Wealth Management, that's where we've been able to create that hedge effect so that we can then pay for a car if it's 60,000 or even 70,000. It really doesn't make a difference to your lifestyle. And that's why we're here at Blanke Schein Wealth Management. So thank you for watching. You have a wonderful weekend. And you know what? Thanksgiving's come up. So have a wonderful, safe, and healthy Thanksgiving with everyone that you love so much. Take care. Have a great one.